Categories, names of, chart of accounts. Oh, hello. Growing up ever so long ago, we played a clapping game on the schoolyard at recess. We had to pick a category and then name things within that category. So in this video, we are breaking down the categories that are the building blocks of our accounting system. As always, clapping is optional. I mean, if you need applause, don't become an accountant. Seriously, no one claps for accountants. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. It's hard to find good help. Let's jump right in. Now, accounting is all about keeping things organized. It's part of the beauty of accounting. Once you understand that structure, your accounting life becomes so much easier. When we talk about structure in accounting, we're talking about what's called a chart of accounts. That chart of accounts lists every different kind of account that we're going to use to track our day-to-day transactions. That chart of accounts breaks accounts into categories or types of accounts. And we start with the 5 basic account types: assets, liabilities, equity, revenue, and expenses. And if you've watched my Accounting Equation Demystified video, these will seem strangely familiar to you. And I'll link that video in the description if you haven't seen it yet. Now, within each of those categories, individual accounts are used to collect our transactions. And you can think of those accounts as buckets that collect our information. So if we pay the electric bill, we take money out of our cash bucket and we put our electric bill in a bucket we call utilities expense. Then at the end of the month, we'll add up each one of our buckets and see how we made out for the month. What's in our cash bucket? How much is in each of our expense buckets? Now, different types of businesses need different types of buckets. So a service business, where you're trading time for money, has a simpler chart of accounts. You need fewer accounts. Then a merchandising business, where you're trading purchased merchandise for money, or a manufacturing business where you're trading manufactured goods for money. Now, a merchandising business would need an asset account for inventory and an expense account for cost of merchandise, where you're buying merchandise to resell it to your customers. A manufacturing business would need accounts for inventory for different things. It would need a raw materials inventory account, a work in process inventory account, and a finished goods inventory account, and an expense account for cost of goods, where you're buying raw materials to turn them into products that you will sell. Now, when a chart of accounts is set up for a business, you can add a numbering system. This isn't required, but it does help in keeping things organized and efficient. And you know I like things to be organized and efficient, so I usually will use account numbers. So if a number system is used, it follows the order of the account types. For example, asset accounts would start with the number 1, liabilities 2, equity 3, revenue 4, expenses and 5. So every account within those categories would be numbered something like 1010 or 1020 or 4010. This is just a way to help us to be more efficient with the way that we do things and to stay more organized. Now, in the case of a merchandising or manufacturing business, we would add a section in the expenses to track the cost of merchandise or the cost of goods. So in that case, the first 4 categories would remain the same as far as the numbering goes, but we would add another section. Now, since most of us, other than certain dinosaurs, are using a software program to track our accounting, and because of that, we have some additional points to consider. Because of the way our software is set up, it uses certain modules for reporting and function. So for example, if you have an asset that is a bank account, in accounting class, we would call this account cash for simplicity. But that account in our software would be named something like Big Bank Checking. And the account type assigned to it would be bank rather than asset. So this tells our software that this is a bank account that we will need to reconcile. And this opens up the magical door to the bank reconciliation module. Whew, love that bank reconciliation module. Makes life so much easier. Now, if we sell to our customers on credit or on account, meaning they will pay us later, in accounting class, we would categorize this as an asset called accounts receivable. In our software, we would call this account type accounts receivable rather than asset. And this tells our software that we will want to be able to invoice our customers, receive payments from our customers, and run reports showing what our customers owe us. If we buy from vendors on credit or on account, in accounting class, we would call this a liability named accounts payable. In our software, we would assign this as an account type called accounts payable rather than liability. And this tells our software that we will be using this to track and pay our bills and to run reports that show us how much we owe to different vendors. The account types don't change. A bank account is still an asset. Accounts payable is still a liability. But within the software, we're accessing some important features that will help make life easier by referring to some accounts by a specific type of asset or liability within the software. Now, how do you set up a chart of accounts? Accounting software makes this very simple. It provides a preset group of accounts based on the type of business. So if you tell the software that you run a hair salon, it will give you a typical chart of accounts for a hair salon. If you tell it you have a retail store, it will give you a preset chart of accounts for a retail store. If you tell it you run a factory, it will give you preset chart of accounts for a factory. Now you're always free to customize the accounts to add on or delete or make inactive or rename them. You can always also group expense types together by using subaccounts. For example, you can group revenue accounts or group payroll expenses or group occupancy expenses. So you can track as much or as little detail as makes sense for your business. Now, the way that we classify accounts is extremely important because it determines where those accounts show up on our financial statements. So if you set up an account called sales and you categorize it as a revenue account, it will turn up just as it should on your income statement. But if you misclassify a revenue account as an asset, for example, it will turn up on your balance sheet. And that would be awkward. As awkward as a dinosaur in a henhouse. Nobody wants that. So there you have it. Everything you ever wanted to know about the chart of accounts but were afraid to ask. Be sure to check out the description for more fundamentals of accounting videos. Until next time, stay balanced, my friends.